Welcome to The Explainer. Today, we're diving into this really fascinating intersection of ancient wealth and modern financial tech. We're going to demystify exactly how the Goldman Sachs Physical Gold ETF, you probably know it by its ticker symbol AAU, actually works behind the scenes. We'll explore how this fund takes literally one of the oldest physical assets on Earth and seamlessly integrates it right into your modern digital portfolio. It's basically a highly efficient bridge between the physical and financial worlds. To start us off, I really want you to think about this practical dilemma. How exactly do you put a heavy physical gold bar into a digital brokerage account? I know, it kind of sounds like a punchline, but it's a very real logistical question. We've seen some absolutely incredible market movements recently. I mean, gold futures hit a staggering record high of just under $4,990 a troy ounce in early 2026. So with the asset class surging to these new heights, a major question for investors is just how such a weighty, highly valuable physical asset can practically fit into a lightweight digital investment strategy. Okay, let's dive into this. Section 1, the physical gold problem. Before we can really appreciate the ETF wrapper, we have to understand the sheer friction involved in owning the raw asset. Let's look at the actual headaches of owning physical gold directly. If you want to buy bullion or coins yourself to get that true zero correlation asset, you're immediately hit with a wave of logistical nightmares. First off, you have to pay high ongoing storage fees for a secure facility or a safety deposit box. Then you need expensive insurance policies because, well, it's an incredibly targeted asset. Plus, there are significant delivery and transport logistics just to get the metal safely to your vault. And, let's not forget the steep commission markups physical dealers charge just to facilitate the trade. For the average retail investor, taking physical delivery is a massive, expensive challenge that eats directly into your returns. Moving on to Section 2, how AAU actually works. The absolutely crucial concept to understand here is allocated gold. This is the core of how a modern digital solution steps in to solve those ancient logistical headaches we just talked about. Think of it like a highly secure coat check ticket for actual gold. AAU operates on a highly transparent system where each ETF share represents a direct, specific claim to an exact amount of physical gold stored securely in a vault. And this is vital because it means the fund completely avoids derivatives, right? They aren't trading futures contracts, they're not playing with paper gold, and they aren't using leverage. This is a tangible digital claim check to physical bullion, which massively reduces counterparty risk while giving you that pure, unhedged exposure. Now, to understand why that allocated structure matters so much, we have to draw a sharp contrast with other ways people try to get gold exposure. AAU provides direct tracking of the gold spot price through that allocated physical backing. Because of this, since its inception, AAU has achieved a staggering 0.99 correlation to physical gold and just a 0.13 correlation to the S&P 500. On the flip side, consider gold mining ETFs. They carry intense equity risk. You're tied to company management decisions, geographical operational issues, general mining risks. In fact, mining equities historically only have a 0.79 correlation to gold returns and a much higher volatility and correlation to the broader stock market. If your goal is true diversification, mixing in equity risk kind of defeats the whole purpose. Which brings us to Section 3, tracking the spot price. So we know the fund holds physical gold, but how exactly does its net asset value stay perfectly pinned to the real-world value of gold day in and day out? This abstract concept of ETF pricing is actually a highly mechanical, daily routine that ensures security and accuracy for the investor. It works like this. Step 1, an independent benchmark administrator, specifically ICE Benchmark Administration Limited, runs a purely electronic, highly regulated auction. Step 2, through this transparent auction, the LBMA PM gold price is established twice daily. That happens at exactly 10:30 a.m. and 3 p.m. London time. Then, Step 3, AAU's net asset value, or NAV, is precisely calculated based on that 3 p.m. London benchmark. By using this independent, globally recognized auction process, the ETF guarantees that its pricing remains highly accurate and fully grounded in the actual physical market. Let's look at Section 4, inside the London vaults. Okay. We have the price and we have the digital shares. But who is actually holding the heavy metal and overseeing this massive operation? Well, behind the AUTTU ETF, you have some major financial heavyweights. Goldman Sachs Asset Management actually completed the acquisition of the fund's sponsorship back in December 2020, and the fund has seen impressive growth since. But what really stands out here is the cost efficiency. AUTTU charges a highly competitive fee of just 18 basis points. When you compare that to the 63 basis points industry average for commodity ETFs, the savings for long-term investors are substantial. And as for who physically holds the gold, the primary custodian is JP Morgan Chase Bank, operating out of their highly secure London branch vaults, with the Bank of New York Mellon serving as the trustee. It's an incredibly robust infrastructure designed for absolute maximum security. And zooming out, we get to Section 5, why this matters now. We've looked deeply at the micro-level plumbing, but let's zoom out to the macroeconomic picture for a second. With over $131 billion traded globally per day, according to the World's Gold Council, gold has serious historical power as a counter-cyclical asset. When inflation heats up, gold goes to work. And this brilliantly illustrates exactly what we're talking about. Based on a 20-year study, in months where inflation spiked above that critical 4% threshold, gold outperformed the S&P 500 nearly 62% of the time. And not only did it outperform, but it beat the broader market by an average of 1.83% per month. To put that into perspective, hypothetical portfolio models show that adding just a 1 to 5% gold allocation to a standard 60-40 portfolio actually lowered overall volatility and improved the Sharpe ratio over 1 year and 3 year periods. It's a true strategic portfolio diversifier.
But it's not just inflation driving the market right now, it's also global uncertainty. As we look at the specific 2026 geopolitical market drivers reported in our source material, we see a really complex web of systemic risks. The data points to escalating tensions over Greenland, the dumping of U.S. treasuries by certain European nations, a broader decline in the U.S. dollar, and ongoing debates regarding Federal Reserve independence. Now, as an explainer, we are definitely not here to take a political stance on any of these events. But strictly from a market analysis perspective, these are exactly the types of severe macroeconomic uncertainties that historically drive investors to seek out safe haven assets.
Which brings us to our final critical thought to leave you with today. Is your portfolio prepared for the next major market shift? And is a digital claim to a physical gold bar the missing piece of your diversification strategy? As we've explored throughout this explainer, AAU offers a transparent, highly correlated, and remarkably cost-effective way to add structural defense to a portfolio without the major headaches of installing a personal vault in your basement. Thank you so much for joining me as we unpack the mechanics of the Goldman Sachs Physical Gold ETF. I encourage you to take this information, look at your own asset allocation, and keep evaluating how these fascinating market tools can work for you.